Hey guys, how's it going? It's been a long time since I posted my last video. It's not because I stopped working anymore. I went back to China for a vacation and stayed there for about a month and a half. So that's why I stopped uploading the video. But now, finally, after I get back from the vacation, we're gonna start talking about something that's probably very interesting to most investors these days. Today's topic is about how to protect yourself from the high interest rate. Also, I want to cover a bit about when to expand your investment portfolio again. We all know that in a high interest rate environment, the borrowing cost is so high that smart investors will always choose to slow down expanding their portfolio, including their business and investing as well. So below are some useful tips to help normal people like us to get through this difficult time. The first thing you should do is to diversify your income sources. Invest in your education or your professional development to increase your earning potential. Cash is king in a high interest rate period. So this is the reason why I kept telling my clients that the cash flow of an investment property is one of the most crucial indicators. It helps you a lot to get through the harshest economic cycle. We keep seeing more and more news like new homeowners forced to sell their homes, losing a big chunk of money because they just cannot afford to cover the mortgage payments anymore. Losing control of your cash flow is basically a catastrophe. So diversify your income source so that you can stay strong in a special period like this. Second point is the emergency fund. Try to put extra funds in the cash flow GIC, for example, so you can take advantage of the high interest rate and stay financially safe in the meantime. Increasing mortgage payments and the trigger rate have made many Canadians suffer a lot. Unlike Americans who can lock in their interest rate for about 30 years, Canadians can usually lock in for 5 years. There are some lenders who are willing to do that to provide something over 5 years fixed rate. But the rates are usually really high that this kind of high interest rate basically kills the desire of doing that as well. So an emergency fund will be a very, very good option to help you keep a safe margin and make sure you don't get bankrupt when things get out of your control. The third point is to reduce the debt and try to refinance to avoid high interest rates. During the interest rate hikes, the most important thing is to create a healthy cash flow. So reducing your debt and the interest rate that comes with it is a main part of this. Try to pay off high interest loan by refinancing with low interest loans. A very good example is from one of my clients actually, who just pays off his commercial loan by refinancing his residential home. The commercial loan he was having was at 9.9%. The interest was crazy. What he did is that he refinanced his current home, the home that he lives in right now, and borrowed out the money which is used to pay off his commercial loan so that he can avoid paying that 9.9% high interest rate mortgage. And the residential mortgage he got from the refinance is only 5.5%. So the gap is huge between these two mortgages. The fourth point is about maintenance and renovations. Keep your properties in good conditions to maintain their value. During downturns, focus on necessary maintenance rather than expensive renovations. This tip corresponds with the first point, which again tells us to be more conservative in the monetary tightening cycle. Keep the renovation funds and wait until the spring comes again, okay? The fifth point is that you have to monitor the interest rates as well. Keeping a close eye on the economic indicators and the financial news so that you can stay ahead of the economic trends and adjust your financial strategies as needed. Stay alert as the market can shift really fast. Conservative investors can wait until the turning point is clear, but it usually means that the competition will be quite intense again in the market. While both investors will start buying when they see a big drop on the price. The worse market it turns into, the happier they will become actually for buyers like that. They tend to increase their investment when the market turns really desperate. But make sure to have a very healthy cash flow when you do this, because it's actually a very risky move these days, for sure. Make sure you get enough funds doing something like that. The sixth point is to maintain a positive mindset. So economic downturns can be really challenging, but maintaining a positive attitude and focusing on the long-term financial goal can help you stay on the track. Just like those who periodically buy the US index funds, regardless of the economic ups and downs, some investors choose to buy rental properties as long as they have enough down payment. This can be another good example of a long-term investing, as we know that real estate always go up in the long run. As long as you can safely hold on to it, keep the assets with you until you retire. So these are the 6 tips I gave to my clients in such a special period. Now back to the real estate market. There's a funny situation going on right now when comparing the GTA market and the Windsor market. I was talking to a few investors that a few days ago. They think that the GTA market is actually performing even worse than the Windsor market. We kind of discussed it a bit and think that the reason behind this is because rich immigrants who choose to stay in big cities like Vancouver and Toronto are also capable of immigrating to another country, while more of middle-class immigrants they would choose to go for a more affordable city like Windsor, like other smaller cities, and they are really not able to do another immigration plan after that. So we have seen more and more immigrants leaving Canada these days due to unaffordable living expenses, including the crazy housing price. Plus, higher percentage of speculators make up buyers group in major cities like Vancouver and Toronto, and they are putting away their money as well. So that's why. What I can see in today's market is that there are still many buyers holding cash and waiting for the good properties to come up. Houses in good neighborhoods and in good shape don't seem to have any problem of selling it. I still see constantly over 10 offers bidding on the offer date for those kind of homes. In the meantime, listings within a bad location or in a bad shape are really struggling to sell. Most of them end up rotting the market these days. Also, I have some really interesting data for those who like to time the market. I was digging some information about the relationship between the housing price and the interest rate. Here is what the historic data tells us. An article from New York Life Investments gathered the data from the past 30 years in the States. Each purple dot, as you can see, represents the year-over-year percentage change of each month within the period. The x-axis represents the year-over-year change of mortgage rate, and the y-axis represents the year-over-year change of average housing price. We can clearly see that the housing price is more likely to decrease in the rate cut cycle, meaning that most of the time the housing price will only start to drop when the government realizes that the economy is going down soon and start to cut the interest rates. The article also finds that the mortgage rates and housing price do have a weak negative correlation of minus 0.15 out of minus 1, but only with a lag effect of 2 years. That's why we are more likely to see the housing price go down in the rate cutting cycle. By putting the graph from one of my previous videos, we do see that more often the housing price goes down when the interest rate goes down in Canada as well. So for those who like to ask when we should start buying again, this is probably a good research for you to look into. Real estate market is typically a long-term investment that will eventually go through economic downturns. So consider investments in the context of a multi-year or multi-decade horizon. Always have an exit plan, or at least get yourself prepared to hold on to it through the winter time. Buy assets, not liabilities. Assets put money in your pocket, whether you work or not. Liabilities take money away from your pocket. That's what Robert Kiyosaki says in his book, and I hope that helps you as well. That's all for this video. Have a nice day, guys.